Good afternoon, everyone. My name is Susan from the CFPB Events Management Team. Thank you for joining us today. I'd like to go over some logistics before we begin. If you are having any issues with your audio, click on the audio button near the bottom middle of your screen. There you have the option of having the WebEx platform dial your phone number and receiving audio that way. The closed captioning link is available by opening, in the chat box by opening the link at the bottom of the screen and clicking on the closed captioning link. During the event, if you have any technical issues, please send me a message in the chat box in the bottom right-hand corner. And if you have any questions during the event, we are collecting all the questions in the chat box as well. So please feel free to put your questions in the chat box and they will do Q&A at the end of the webinar. And now I'm going to turn it over to Heather Brown.
Thank you very much, Susan. I appreciate it. Good afternoon, everyone, and welcome to Unpacking the Black Wealth Gap, Historical Lessons of Credit Discrimination. First, I want to offer thanks to Imani Harvey and also our Rise Black Employee Resource Group, who originally conceived the idea of having this presentation internally. And when I saw it internally, I thought it would be a fantastic thing for financial practitioners to also have the opportunity to see. So I also want to thank my leadership, Dubis Carril and Desmond Brown, for their early support on this and bringing the webinar to our financial practitioners. As timing would have it, it worked out well because our acting director, Dave Wiu, has said that his policy priorities for the agency are going to be around racial equity and relief for consumers. So even though we started this, well, probably then past summer, the end of the summer, maybe leading toward the fall, it turned out to be very timely. So again, we're welcoming everybody, and I want to just let everyone know that the slides will be available online, and you can also email the address I'll give you at the in a few minutes if you wanted to get a copy of the deck for yourself. Now, I additionally wanted to go ahead and introduce Dr. Charles Nair now, so that when I get through my preliminary slides, you'll already have the introduction out of the way and we can just get started. So we're very excited to have Dr. Charles Nair. He's senior counsel with the Office of Supervision Policy here at CFPB, and he works in fair lending. He works on fair lending supervisory examinations and has worked on a number of significant fair lending enforcement matters. Prior to his employment with the CFPB, Mr. Nair served as supervising attorney with the Pennsylvania Human Relations Commission. He was responsible for investigating and litigating cases to enforce Pennsylvania's civil rights laws in the areas of lending, housing, education, employment, and public accommodations. Dr. Nair has published a number of legal and historical civil rights articles. He graduated from Ohio University with a BA and Penn State's Dickinson School of Law with a JD. He also earned a LLM, Master's of Laws, from the Georgetown University Law School, and he has a PhD in history from Temple University. So he's he has just an interesting and amazing background for doing this kind of particular research, and we're so glad to have him, and we welcome him and look forward to his presentation. Actually, the ball was given to you, Dr. Nair. If you don't mind just dropping it back so I can get through my preliminary slides and the disclaimer, then we'll move on. All right, so I have to get through our standard disclaimer quickly. I know many of you have seen it, but it's important for us to do each time. This presentation is being made by a Consumer Financial Protection Bureau representatives actually, myself and Dr. Nair. On behalf of the Bureau, it does not constitute legal interpretation, guidance, or any advice of the Bureau. The opinions stated by the presenter are the presenter's own and may not represent the Bureau's views. The inclusion of links or references to third-party sites does not necessarily reflect our endorsement of those third parties. I don't believe there are any in this one. The document that we're using is in support of a live discussion. So when you share it with others, we just want them to understand as they read through it that it doesn't necessarily express what we experienced in its entirety. We are also recording this and plan to get it posted on our website. I just wanted to touch base on how, something that's so important of the work that we do. Research was done before I even came to the Bureau, and 5 principles of effective adult education was developed. Many of you may already have seen it or be using it. It has been around for a while. If you haven't, I encourage you to go to the link at the bottom and get a copy of it. This is a summary of the full research. We also on the website have full research on it that basically validates each of the items that you see. And I'm not gonna read through all of these, but these are the 5 principles here. But we are gonna emphasize the first one for this workshop, knowing the individuals and families to be served. So I just wanted to touch on a couple things around that before we get started. And we have a quote from our acting director, and he said that in a letter or email to our workforce, it's well known that there have been policies of the financial services industry that have both caused and exacerbated racial inequity. And so it's important for financial practitioners of all races to be aware of this for this population and also for other populations that are marginalized. The importance of it is that it's hard to provide services to people if you don't really understand the walk that they've been through. It's also important so for everyone to know this so they can also share with their audiences that there is no shame in being poor and struggling, and people really of all economic levels probably struggle at some point, but particularly for Black and Brown Americans, it's important for them to understand the history, for financial practitioners to understand the history and to realize that there are reasons why there is this huge Black wealth gap, and there are systematic causes of it. So the objective of this presentation is to help financial practitioners understand the history of those practices and help them better serve their audience. When financial practitioners are working with Black and Brown stakeholders, it's important to understand their unique financial challenges based on historical events and how those events have led to many experiencing the Black wealth gap today. Financial education programs can be more effective if they're matched to that individual specific goals, circumstances, rather than a one-size-fits-all approach. And also knowing your stakeholders' approach is good for all audiences and can help financial educators tailor programs according to learner needs and develop realistic expectations. So this really just covers that first point. And if you want to know more, you can go back and download that document or the full research. The research actually was done to show people how to help motivate their clients through financial education. Okay, so with that, I think we're going to hand it over to Dr. Nair. And Dr. Nair, are you all set?
I am all set. Can you hear me?
Okay, thank you. We're looking forward to it.
Very good. Thank you, Heather, and thank you for that kind introduction. And thank you to everyone for joining us this afternoon, as we're basically going to take a walk through 400 years of U.S. history that focuses on the relationship between credit discrimination and racial wealth inequality. So with that, I just have one bit of housekeeping. I have included a number of quotes in this presentation, and they're designed to give voice and agency to some of the historical figures that we're going to discuss today. I have kept those quotes in their original form in the interest of historical accuracy. So with that, why don't we just get started? So first, let's talk about what wealth in the United States even is. So wealth is the total extent of an individual's assets less any debt, basically. And wealth has, I think as everyone's aware, an enormous impact on a wide variety of life opportunities for folks. It impacts education, housing, employment, social capital, and it also provides for intergenerational transfers, which further help in the areas of education, housing, and employment. And in fact, I think wealth is likely the single best indicator of racial wealth or racial inequality in the country. So where does that take us? So the Federal Reserve recently released some updated racial wealth data from the 2019 survey of consumer finance. And what that data revealed was a very large racial wealth disparity. Oops. So African-American households had a median net worth of about $24,000 and a mean net worth of approximately 142,000. In contrast, white households had a median net wealth of 188,000 and a mean of 983,000. So as you can see, very large racial wealth gap. And that gap has been quite durable and quite consistent for decades, if not hundreds of years. So in the United States, I think it's well understood that the single most important means to accumulate wealth for most families is home ownership. It is the driver of wealth accumulation for the vast majority of Americans in this country. And as of Q4 2020, the most recent data, the home ownership rate gap between African Americans and whites stood at 30.4%. And that's actually pretty large. It's in fact the largest that gap has been in the past 50 years. And that gap is also quite durable. It has consistently exceeded 25% throughout the entire 20th century. And right now is actually at near sort of historical high levels at 30.4%. And this graph, or this image, gives you sort of a graph of those disparities and how they trace over time, starting with 1900 all the way through 2015. And the top line is basically the white rate, and the blue rate is the African American rate, and it also includes the Asian and Latino rates as well. But you see the rates, they pretty much track one another. In other words, when the white rate goes up, the African American rate goes up, and the inverse is also true. But what is quite consistent about this is the gap never actually closes in any meaningful way. And actually, if you can see sort of the tail end of the graph, it's actually expanding. So I think this graph sort of visually displays the consistency and durability of the home ownership gap between whites and African Americans. So, one explanation that I think for the racial wealth gap is clearly the racial home ownership gap. And since few people have the financial resources to purchase a home, most have to resort to financing. So a key component to achieving home ownership is access to fair and equitable credit. And what we really have is sort of a continuum where with wealth at the top, in order to accumulate wealth, you typically need to have home ownership. And to achieve home ownership, you typically need to have access to credit. And that really takes us to the focus of what we're going to talk about here today, and that's structural discrimination in terms of accessing that credit, which in turn feeds home ownership and ultimately wealth accumulation. So I think it's important when you talk about racial wealth inequality to talk about the historical context of the discriminatory and structural barriers that have impeded Black wealth accumulation throughout the country's history. And basically what I'm going to argue today, or what I'm going to present today, are what I see as three distinct generations of racial credit discrimination and predatory lending. And roughly those fall into, I think, three categories, with the first being the post-Emancipation era, which really starts in 1865 and runs through the early 20th century, followed by the Great Migration era, which runs roughly from approximately 1910 to 1960, 70 time period. And then finally, the more recent subprime crisis, which was in the late 1900s up through, or 1990s up through approximately 2008 in the aftermath. So let's pick it up really sort of from the beginning. So on the eve of the Civil War, the African American population in the United States is about 4.5 million, with approximately 90% of that held in bondage in the South, with the remaining 10% in the North. So during those 246 years of slavery in America, enslaved individuals could not legally own land, assets, or otherwise accumulate wealth in any meaningful fashion. And even those in the North who were able to accumulate wealth often faced rampant discrimination that impeded their ability to accumulate wealth. And you see that in 1863, after the Emancipation Proclamation is signed, African Americans have less than 1% of the total wealth in the United States. So in other words, 99.5% of the wealth in the United States is owned by white folks. And a lot of that is essentially driven by cotton and the production of cotton in the United States and how important that was to the economic growth of the United States. And you really can see that in the next bullet, which talks about wealth for white folks. And it breaks it down by geography. So in the North, in 1860, the average white household had about $546 in wealth. Now let's sort of head down further south. So the average free Southerner had almost double that. And then as you proceed farther south into the future Confederate states, it increases to about $1,255. And finally then in the Deep South, where cotton production was most prevalent, the average white household had about $1,500 in wealth. In fact, the highest rate of wealth accumulation in the United States was focused in the area where cotton production was most prevalent, as of course was slavery. So after the Emancipation Proclamation and the passage of the 13th Amendment abolishing slavery, it's not surprising that the newly freed persons immediately understood and identified land ownership as an essential element of defining their freedom. In fact, they were held in bondage for 246 years, working the lands and the fields and cotton production, and understood the value of land and how important that was to ensuring freedom. And despite some initial land redistribution efforts, by 1867, it's clear the federal government is not going to provide African Americans any type of significant restitution for their years of involuntary servitude. It's clear that 40 acres and a mule is not going to happen. There were some preliminary efforts, but those were ultimately rescinded by President Andrew Johnson. So what does that lead us to? It leads us to, with the demise of slavery and the failure of land reform, land ownership and wealth accumulation, it's going to occur in the context of a new system of labor. And that system of labor is known as sharecropping. And basically under sharecropping, most of the large plantations were subdivided into individual farms, and those range from 10 to 30 acres. And basically the individual plots of land were worked by African Americans in return for a portion of the crop. And in many ways, this represented a compromise. African Americans wanted to own their own land, whereas the white landowners wanted to return to a gang system of labor that was prevalent in slavery. So in some respects, sharecropping was a compromise of those two positions, with African Americans afforded a degree of autonomy in terms of working the individual farms, but yet white folks still having the economic control over that land. And as time progresses, the institution will become much more economically coercive, and we'll discuss that here in the next few slides. So how does the sharecropping relationship work? Well, it was really essentially a ladder. So on the top, you had farmers who typically rented their land and paid for that with a fixed sum of cash or its equivalent in crop values. And they usually owned their own equipment and animals and maintained ownership over that crop. And share tenants were quite similar. They also were renters and paid for it with a share, typically a third to a fourth. And again, they owned their land, they owned their equipment and animals, and maintained ownership of the crop. And that's really sort of the key distinction here. Both cash and share tenants had legal ownership of the crop. So in contrast, sharecroppers are working a piece of land, they're not renting it, and they were paid by the owner with a share of that raised crop, and it was typically a half. Typically, they did not own farm equipment or animals, and most critically, did not have legal title to the crop. So what does that mean? So what's the difference between a renter and a cropper? So the farmer's position then is directly correlated to their wealth accumulation. In other words, if you have assets, you're likely to be a renter. If you don't have any assets, you're likely to be a sharecropper. So not surprisingly, In the wake of Emancipation, most African Americans had few to no assets, and the majority were relegated to the status of sharecroppers on the bottom rung of that agricultural ladder. And there's a quote there from Bessie Jones, which I think really captures sort of the essence of this relationship, where she said, "You see, a sharecropper don't ever have nothing. Before you know it, the man done took it all. But a renter always have something, and then he go to work when he want to go to work." And I think Miss Jones, in her own way, really captures sort of the essence of the difference between sharecroppers and renters. And she's really talking about control and the ability to sort of manage one's own affairs and direct their own agency in terms of how they choose to exercise control over their economic well-being. This map sort of gives you an image of the South and how prevalent sharecropping became during this time period, with the darker red being those areas that were 35 to 80% sharecroppers. And you see that really traces sort of the old, the old Confederacy with South Carolina, Georgia, Mississippi, into Texas having very heavy shades of red, where sharecropping was quite prevalent and correlated to cotton production. And this is an image of what a typical sharecropper house might have looked like back then. Basically a small wooden structure with a chimney for heat. So why am I telling you all this information about sharecropping? And the reason is because the sharecropping relationship is not just a system of labor. It also creates a credit relationship. And the sharecropper basically planted his or her crop. It was usually cotton, almost exclusively cotton, in early spring, and it didn't harvest and sell until late in the year, November or December. So with few assets during the cotton season, which is a long season, from spring all the way to the beginning of winter, sharecroppers typically required some form of short-term credit to sustain themselves. And at this time period, it's important to remember that the banking system of the South had basically been destroyed during the Civil War. And in fact, in the first 3 years after the Civil War, there were 1,688 banks organized and established, but only 20 of those were in the Deep South. So there was really no banking system to speak of. And with financial institutions both unwilling and unable to provide that credit, that vacuum, that credit vacuum, was filled by the local merchant. And what was the merchants? There were thousands of these stores throughout the South. They ran a general store. They sold a wide variety of goods, ranging from basic food to clothing to luxury items. And with few people to have the ability to pay with cash, the merchant operates almost exclusively through credit transactions. So the key to the merchant's power, it's not what he's selling. It's not the buying and selling of these goods, but rather it's his near monopolistic control over credit. And so African Americans who wanted to commence small-scale farming in the context of the sharecropping system were basically furnished by the merchant. And by that, I mean the merchant basically provided food, necessities, farming equipment, all the supplies that were necessary to plant a crop. And without cash to buy that stuff, the merchant advanced these necessities to African Americans on a fixed credit limit, and most critically secured by a lien on the crop. And that is an image of what one of these stores typically looked like. Just a small general store selling a lot of supplies. So the merchant was able to use his control, his almost unfettered control over credit, in a predatory manner in two respects. So first, the merchant had a two-tiered pricing system. So there was a price for goods you bought for cash, and a second price for goods purchased on credit. And one study determined that the average price for goods purchased on credit was about 55% higher than the cash price, with ranges from about nearly as high as 90% to a low of 33%. Now, second, the merchant established an interest rate for the goods purchased on credit. And typically, the merchant had his sole discretion in determining what that interest rate might be. It was based on subjective determination of creditworthiness, known only really to the merchant. And typically, that interest rate that was charged was 8 to 15%. That was added to the credit price. So you basically had a twofold combination, which results in effective interest rates running from 30% to 70%. And this was confirmed by a study in Georgia in the late 1800s that revealed a range from 44% to a high of almost 75%. So certainly, astronomical interest rates, and particularly when you consider what the going rate was at the time. In New York, short-term interest rates were about 4 to 6%, and they never exceeded more than 8%. So the access to credit that was provided to African Americans was done so in I think, a very clearly predatory manner in terms of the interest rates. But it also had other sort of very negative connotations and implications. And this really happened often at settlement time. So at settlement time, the sharecropper, they harvest the crops in the fall and accounts are settled in the months of October through December. And since the merchant has the legal title to that crop, because of that crop lien, the sharecropper doesn't have control to sell that. Rather, the sharecropper has to turn the crop over to the merchant, who then has the power to sell it on the open market. So, and this really led to the moment of truth. And that's at settlement time. The merchant informs the sharecropper of the amount that the crop sold for on the open market. And remember that the sharecropper had no involvement in the actual share or the actual sale of the crop. It was all up to the merchant. So the merchant then proceeded to add the total advances based upon purchases made during the year. Then they entered the interest charge against the total sales amount. So the total of the advances plus interest was deducted from the sales proceeds to determine whether there was a profit or a loss for the year. And there's an image of the actual cotton being weighed prior to sale. So African American sharecroppers were not given any sales receipts. There's no itemized statements. There's no discussion about the sales price, really. And they were, not surprisingly, routinely cheated at settlement. One Freeman Bureau official, the Freeman Bureau was established after the Civil War, recalled that white men who are honorable in their dealings with their white neighbors will cheat the Negro without feeling a single twinge of their honor. And that was confirmed by a study of South Carolina, where 101 out of 118 African Americans felt they had been cheated badly by their white bosses. And sort of this dilemma was, I think, summarized by the quote on the slide from a Mississippi sharecropper, who basically said, "I've been living in this Delta 30 years, but there's no use jumping out of the frying pan and into the fire. If we ask any questions, we are cussed, and if we raise up, we are shot, and that ends it." I think that in many ways sort of eloquently summarizes the lack of ability to in any way question the merchant in settlement in particular. And just to give you an example of the potential consequences, I'd like to talk a little bit about Anthony Crawford, and that's a picture of Mr. Crawford. Now, he was quite prosperous, owned 427 acres of land in South Carolina. He was very involved in the local African-American community. But one day on October 21st, 1916, he came to town to sell his cotton. However, he got in a quarrel with a white merchant over the price. And as a result of the quarrel, Crawford was jailed. And later that day, a mob of 200 people removed Crawford from the local jail, beat him, dragged him through the black neighborhood with a rope around his neck, hung him from a pine tree, and shot him over 200 times. And the next day, in the local paper, explained Crawford's death, basically saying it was inevitable and racially justified due to his own reckless course due to chest inflation from wealth. And in fact, Mr. Crawford's case, unfortunately, it was not unique. The entire system, in many ways, was held together through violence, ranging from the daily indignities to beatings to lynchings to mob lynchings. There were several thousand lynchings during this time period, and they were sort of the most clear-cut example of how violence was used to keep this system in place. And I think that quote that was in a local paper sort of accurately summarized it, where it was racially justified if someone acted, quote unquote, basically inappropriately due to chest inflation from wealth. So with that, due to high interest rate charges, this cheating at settlement time, the sales price of the crop was often less than the merchant advances, submerging African Americans into debt each year. And one study found that about 62% broke even, 26% went into debt, and a small fraction, 9.4%, made a profit. And I have a quote there from Amanda Walker, who expresses, I think, sort of the dilemma and the frustration here of this economically coercive system. After the last bale was sold, him come home with the same sick smile and the same sad tale. Well, Mandy, as usual, I settled up, and it was not is not, figure is figure, all for the white man and none for the N-word. So I think Ms. Walker is capturing very clearly what happened at settlement time and how African Americans were routinely cheated in such a way that it maintained them in a system of what amounted to near debt peonage. So in spite of all that, I think one of the most significant things to talk about is land ownership in African Americans. So I know I presented sort of some very depressing information about this sharecropping system, but in spite of all these obstacles, African Americans were able to accomplish land ownership in what I think are surprisingly large numbers in the South, considering the circumstances. So by 1910, throughout the South, African American land ownership in rural areas is about 24%, 1 in 4, and in urban areas it's about 21%, about 1 in 5. The mean value of African American farms, including livestock, basically their assets, was about $1,588. I will say the farms were typically smaller in comparison to white farms, often fewer than 50 acres, and they were often clustered together. And the land was generally of poor quality. Nevertheless, I think those numbers are pretty significant and really represent a testament to sort of African American tenacity in overcoming some of these obstacles to achieve land ownership. So how did it work? How were folks able to purchase land in this system? Well, it wasn't uniform, and there were many different ways that it happened. But the purchase of land often required several central elements. It typically required income household production. So by that I mean there had to be income coming in from somewhere else besides just farming. And it typically involved asset building via livestock or personal property, because that then allowed the sharecropper to move his way up the agricultural ladder, gain more economic control, and build towards land ownership. It also often required a white sponsor, and typically the purchaser was also literate. I think we see the quote from Ned Cobb talk a little bit about that and the struggles he went through. So we watched and scuffled for 4 years, first one way, then another, making baskets, cutting stove wood for people, until I could buy me a mule so I could rent a little land and go to work and run my own affairs. So Mr. Cobb is talking about how he worked his way up that agricultural ladder. He does eventually achieve land ownership, but it's only after many years in many different sort of streams of income production to allow him to buy the mule, which will allow him then to become a renter and then move his way up the up the ladder. So now, but let's compare that to white land ownership. So it does pale in comparison to the white rate. So for example, the overall rate of farm ownership in the South for whites in 1910 was about 60%. You compare that to 24% for African Americans. And the overall rate of white homeownership was 48% in 1900. The mean value of a white farm, including livestock, was almost $4,000, so certainly significantly higher than an African American farm wealth. And whites also benefited from a number of laws that essentially provided free or cheap land to settlers. For instance, head rights. Head rights worked where, if someone brought over to the colonies an indentured servant or a slave, they were essentially awarded land. And land was also given through these various land grants as well as homestead acts, whereby if you settled on a piece of land for a specific period of time, that land would become yours. Now, African Americans were largely shut out of these programs. There was some minor participation in the homestead acts after the Civil War, but for the most part, they were essentially precluded from participation in this free and cheap land. So where does that take us? So beginning in 1619 through the Civil War, the vast majority of African Americans, about 90%, basically are completely precluded from any property ownership and wealth accumulation. And then from the Civil War to the beginning of the 20th century, the majority of African Americans were trapped in a system of debt peonage, driven by predatory credit discrimination in an agricultural system that was based on cotton production and severely constrained their ability to accumulate wealth. And I think one of the ironies of the entire sharecropping system, while basically initially between African Americans and whites, the system eventually over time begins trapping more and more whites into this system. So, the great irony was that it was really sort of a tool to control African Americans and African American labor. But over time, it becomes so corrosive, it also begins to impact whites in a very negative way, although certainly not to the same extent proportionally that it did for African Americans. So with that, I just want to take a second to walk a few slides that show some images of African American sharecroppers. And I think these are really important to provide faces and agency to the historical actors. And just looking at the determination in their eyes as well as the quiet dignity expressed in their faces, I think is a pretty powerful statement. So with that, let's turn to what I call the second generation of racial credit discrimination. And it really started with the Great Migration. So intent on escaping the violence and discrimination of the South, between 1910 and 1970, millions of African Americans leave the South for the urban cities of the North, Midwest, and West, seeking both economic and educational opportunities. And this Great Migration really occurred in two waves. The first wave from 1910 to 1940, roughly it begins really with the First World War, which in turn creates a demand for labor. And about 1.6 million arrived primarily in the cities of the Northeast. And you can see that in the statistics there from New York City, where in just 30 years, the population, just goes through the roof, from 140,000 to 650,000. And then the second Great Migration, again, triggered primarily by World War II, and the demand, again, the increased demand for labor. And that's even larger than the first wave, 3.5 million. And it's also more geographically diverse. It's not only the Northeast, but the Midwest and the West as well. In fact, you see that in those statistics from Los Angeles in San Francisco, where the population essentially rose tenfold in just 30 years. And in fact, this is the largest internal movement of any group in American history. And this map gives you some of the main routes of the Great Migration. This is the first Great Migration. You see basically leaving the Deep South for the urban cities of the North, St. Louis, Chicago, Detroit, Baltimore, Philadelphia, New York City. And later this will expand out west to California, San Francisco, and other large urban areas. So when African Americans are arriving in the North, they didn't give up their desire to own homes. And in fact, one of the pieces of what one historian called the cultural baggage that they brought with them was the desire for home ownership. In the early 20th century, we had a much different mortgage finance system than we do today. So mortgages were typically required a large down payment. It was usually half of the purchase price, with the remainder financed with a straight mortgage. And the interest rates of 2 to 6% with fees of about 3 to 6%. Today, we'd call that basically a 5-year term, interest only with a balloon payment. And borrowers were typically required to take out a second mortgage to cover that large down payment. Remember, you had to put half down. And that second mortgage came at a higher interest rate, 4 to 12%, with much higher fees, as high as 20%. And again, short terms, 1 to 3 year terms, with additional fees upon renewal. You know, and typically borrowers sometimes even had to use a thirds mortgage, a smaller third mortgage, to cover fees and the first payment. So it was not easy for anybody at this time period to purchase a home, given the financing system that was in place. With that being said, African Americans, I think, encountered some additional obstacles as they tried to finance home purchases. First, many banks just simply refused to lend to African Americans. And even if a bank did make a loan, the terms and conditions were often much more onerous than compared to whites. And by that, usually it was about double the interest rates and double the fees, if in fact they could secure financing at all. And Raymond Pace Alexander, I've included a quote from him. He was a very prominent African-American lawyer in Philadelphia. He explained, if a colored man owned City Hall, he would be unable to get a first mortgage on it at this bank. They absolutely refused to lend money in any manner to Negroes. So without access to traditional mortgage credit, African Americans often relied upon installment or land contracts to finance a home. So under such a contract, the owner basically sold the property to the buyer at an agreed on price. It was financed through a series of installment payments that were made directly to the original owner. So there's no banks involved, there's no finance companies. It's a straight up contractual relationship. While it did facilitate home ownership, it was also subject to discriminatory and predatory practices. So let's talk about a few ways that those practices occurred. First, the buyer does not acquire title to the property until the installment payments were complete, and they did not gain any equity in the property during the contract. So, you know, unlike a mortgage where you gain equity over time, there's no such thing happening with an installment contract. Third, if the buyer misses a payment, the seller can cancel the contract and take back the property, and they can do that through an eviction as opposed to a foreclosure, which was much more simpler and much cheaper. Fourth, there's usury laws. Mortgage interest rate ceilings did not apply to such contracts like they would for a mortgage. The buyer could be kept ignorant of the actual value of the property since there's no appraisal associated with this transaction. And finally, the buyer was also then responsible for all maintenance, insurance, repairs, and expenses associated with the property. And oftentimes these properties were in poor condition and required considerable repairs. And the buyer was responsible for all of that. So just to give you an example of the Sweets who purchased a home in Detroit. So in 1925, Mr. Sweet, who was an African-American doctor, and his wife bought a home in a white neighborhood in Detroit. They paid about $18,500 to the white sellers when the standard price is about $12,000 to $13,000. So they're paying, approximately a 30-some% markup on the sales price. They made a down payment of 20%, with the remainder financed with an installment contract consisting of 120 monthly payments of $150 for an effective interest rate of 18%. So interestingly, you're seeing sort of the same dynamic that we saw in sharecropping, where we have inflated prices and very high interest rates. It's the same dynamic occurring in installment contracts. And of course, the Sweets case became quite famous because after they moved in, they were greeted by white mobs who did not obviously want African Americans moving into their neighborhood. Shots were fired, a white person was killed. The Sweets were charged with murder in a very sort of celebrity case. Clarence Darrow represented the Sweets, and they were ultimately, after a mistrial, the charges were ultimately dropped against them. But again, it speaks to sort of the oppressive terms that were applicable in an installment contract. But at the same time, again, I don't want to focus on sort of all the negative. This also was a golden age of black banking. So as the African-American migration heats up, it is increasing racial violence and housing segregation, as we clearly saw with what happened with the Sweets. But in turn, this is creating a separate African-American economy that also presents economic opportunities, and it encourages civil rights activism. So from 1900 to 1934, 130 African-American owned banks were established. And by 1930, there's 73 African-American owned building and loan associations. And most of those were typically affiliated with an African-American church. So these financial institutions are able to provide mortgages, and they're able to do that on reasonable terms and conditions, and does provide some access to credit for African Americans. And we see this in Philadelphia, where one study from 1910 to 1929 found that 19 building and loan associations originated at least 1,216 mortgage loans to African Americans. So, there is unquestionably a credit vacuum in African American neighborhoods, but to a certain extent, African American owned financial institutions are able to fill part of that vacuum. That being said, they still faced, capital and liquidity limitations, market constraints, and asset depreciations. But I do want to talk about, one sort of specific example, and this name is Major Richard Wright Sr. and his bank, known as the Citizens Bank. So Mr. Really an incredible story. Mr. Wright was born an enslaved person in a log cabin in Georgia in 1855. He manages, his mother's determined to get him an education, and he ultimately graduates from Atlanta University and became president of the Georgia State Industrial College for Colored Youth, which is now known as Savannah State. He's a very prominent figure in the local community, a well-known educator. But one day after Wright's daughter was insulted in a local bank while she was trying to make a deposit, he demanded an apology from the bank's president, who he knew, given they were both members of the local community. The bank president refused to apologize, and Wright on the spot said and vowed he was going to start his own bank. So at the age of 67, after an entire career basically in education, spurred on by the insult, Wright left the South. And in September 15, 1920, he and his family opened the Citizens and Southern Bank in Philadelphia, Pennsylvania. And to counter discrimination and fraud in the mortgage market, which he was keenly aware of because he studied the mortgage market in Philadelphia and understood that African Americans were being routinely cheated out of hundreds of thousands of dollars. So what he does is he establishes a trust company, the first African American trust company, and that's designed to provide a full range of financial services to African American home buyers. So it assists with reviewing documents, protecting down payments, examining closing documents, and representing buyers at closing, with the goal being to achieve home ownership and protect African Americans from real estate sharks. So by 1930, Citizens had 161,000 in capital, 6,000 deposit accounts, 1,300 checking accounts, and they had provided over 1,000 loans to African Americans. And Wright also goes on to establish and be the first president of the National Negro Bankers Association. So really a remarkable career. And in fact, he was a major as well. He was appointed a major in the Spanish-American War. And the Citizens Bank was around until into the 70s when the Wright family finally sold their controlling interest. So what else happens in this time? So of course the big event is October 29th, 1929. The stock market collapses and we begin the Great Depression. And it's just devastating to the country. 5,000 banks closed. Interestingly, we just talked about Citizens Bank and Wright's Bank. It did survive, but a number of African American banks did not survive, as did thousands of other banks. $7 billion in depositor funds vanish. Housing construction comes to an almost standstill, 95% drop. By 1933, just remarkable. You have half of all mortgages are in default in the country, with foreclosures running 1,000 per day. So with the election of Franklin Roosevelt, the federal government basically decides to revolutionize housing finance, to rescue the market and to make homeownership more accessible. Now, unfortunately, the system that the government does introduce to support homeownership placed discriminatory barriers in the path of African Americans. And it starts really with the Homeowners Loan Corporation, which was established in 1933. It's designed to assist families in danger of foreclosure and basically refinanced their existing delinquent mortgages. And it was quite successful. Over $3 billion for over 1 million mortgages. 40% of all qualified mortgagees sought assistance from the program, so very widely used. And for the first time, we talked a little bit about what mortgages looked like back then, but for the first time we have 15-year term notes, fully amortized, at interest rates of 5%. Now, today, that's sort of the standard product, 15, 30-year mortgage, but that was revolutionary at the time. And since the HOLC was dealing with mortgages in default and potential foreclosure, and it was making loans on those properties, it introduced appraisals of properties and communities, and I mean standardized appraisals across the industry, in order to assess possible risk. And to do that, it commenced a city survey program to appraise the level of real estate risk in cities throughout the United States. Every city in the United States, 239 cities, every major city. And it did this by distributing questionnaire forms to local real estate professionals and mortgage lenders designed to measure risk. Now, unfortunately, in rating neighborhoods, the risk assessments incorporated existing notions of ethnic and racial worth. And in fact, there was no more important socioeconomic characteristic for appraisal purposes than race. The HOLC, for example, monitored the movement of African Americans. Another example is it charted the density of African American neighborhoods. In fact, this relationship between race and real estate value was critical to its entire appraisal process. And you can see this. This is one of the survey forms that were sent out. And I know it's a little difficult to read, but it does talk about sort of, detrimental influences where it references Negro. It specifically asks whether there's Negro populations in percentages, and then it has a question of infiltration of, and then a blank space. This particular form also again notes quote unquote Negroes, and in turn the neighborhood was rated red, which was the most risky classification. So these forms are just going out, thousands and thousands of them, and they in turn drive this entire system, this risk assessment system, where the HOLC develops 4 color-coded categories of risk of all these cities across the country. So the first category are coded green. These are the best areas, and they're in demand in good times and bad. Blue represent areas that had peaked but are still quite desirable. Yellow are areas that were definitely declining. And then D represented hazardous areas in which the things taking place in the C areas have already happened, characterized by detrimental influences of a pronounced degree, undesirable populations, or an infiltration of it. Now, African-American neighborhoods, given the criteria, were almost always rated fourth by the HOLC, coded red, and hence that's where the term redlining originated. So for example, Detroit, every neighborhood with any degree of African-American population was rated D or hazardous, coded red, and redlined by federal appraisers. Now, following the completion of this rating system, the HOLC prepared a series of color-coded residential security maps that detailed these various real estate risk grades. And some of you may be familiar with them. They received a fair amount of attention over the last few years, but for a number of years, these were just sitting in the National Archives in Washington, D.C. Nobody really was even aware of them or recalled them until a historian came across them in the 80s. And these basically sort of represent risk detailed on a map. And you see the areas of red, and as you proceed out from the core, this is Atlanta, you get some more yellow, then some blue, and then it begins to turn green. And this is Los Angeles, where again you see sort of the same dynamic. So what's the impact of all this? Now the HOLC, it did have a mixed record of mortgage lending. It did make loans in yellow and red areas. However, African Americans were still subject to discriminatory practices. The D-rated areas are typically charged higher interest rates. It reinforced segregation because it refused to sell and make loans to African Americans for properties in white areas. So it was reinforcing segregation. And it underappraised typically the value of African American areas. But really its major damage is it adopts, it elaborates, it implicitly then places the federal government's seal of approval on this notion, this relationship between real estate value and race. And this system is then adopted by private financial institutions. And the entire practice of redlining is then essentially institutionalized in the finance system. And that really becomes even more significant with the Federal Housing Administration, which was established in 1937 to facilitate financing on reasonable terms. The FHA did not directly lend money, but rather it provided financial incentives by insuring up to 90% on any loss. And with that risk reduced, the FHA's success is really remarkable, and housing starts just to explode. Because remember, at the end of during the Great Depression, housing starts had basically stopped. But you see, this is hugely successful. By 1972, the FHA has assisted 11 million families in achieving home ownership. A truly, really remarkable program. But it came at a price because it's largely confined to white areas in the suburbs, to the detriment of African Americans who are being segregated and residing in the urban areas throughout the country. So how did that work? So the FHA, like the HOLC, required an unbiased professional estimate in order to guarantee a loan to ensure the value of the property would exceed the mortgage debt. So it acted upon the HOLC's guidelines and developed even more elaborate advice on race and real estate value in its underwriting manual, which was its manual designed to assess whether it was going to make a loan or not. So this is an excerpt from the manual where it basically says, if a neighborhood is to retain stability, it's necessary that the property shall continue to be occupied by the same social and racial classes. A change in social or racial occupancy generally leads to instability and a reduction in values. So there you really have it right there, is sort of the relationship, the negative relationship between race and value. And the manual warned of the dangers of infiltration of our inharmonious racial groups and nationality groups. It recommended to avoid this by using restrictive covenants as an excellent tool to maintain neighborhood stability. And a restrictive covenant basically is a clause contained in the mortgage deed that says the property cannot be sold to African Americans or additional ethnicities. And you know, interestingly, these are still in a lot of the mortgage records. In fact, you know, I've been approached by folks who said, you know, I went back and looked at my deed, and sure enough, it had a restrictive covenant. So in short, you know, the entire appraisal process at this point is really based on the premise that racial segregation is necessary to ensure property value. And like the HOLC, the FHA actions were adopted by private financial institutions, institutionalizing the practice of redlining. For example, in Chicago, a survey of 241 savings and loan institutions found that only 19 were willing to make loans to Blacks purchasing homes in Black areas, and only a single institution was willing to grant a mortgage to an African American moving to a white neighborhood. So that really, I think, captures, that survey captured sort of how prevalent the practice of redlining was. And it's also summarized by I. Maximilian Martin, who was an African American real estate expert in Philadelphia, where he said, today, however, a very decided bias exists on the part of mortgage lending agencies. Upon learning the racial identity of an applicant or on finding that the property is occupied by colored people, the loan is often immediately rejected without any further investigation. So I think you can most dramatically see this in some of the documents. So as late as 1951, the McMichaels Appraising Manual, which was at the time considered, you know, quote unquote, the Bible of appraising, it actually included a listing, a ranking of ethnic groups in terms of those who were most desirable to those who had the greatest negative impact on property values. With English, German, Scotch, Irish, and Scandinavians, sort of Western Europeans being at the top of the list. And at the bottom, at 9 and 10, were Negroes and Mexicans. I think this sort of speaks to how widespread these notions of race and real estate value have been incorporated into the industry, fueling the practice of redlining. And just to give you another example of Detroit, there was a developer who proposed an all-white subdivision next to a Black neighborhood, which had previously been rated as D, or hazardous. Not the white neighborhood, the Black neighborhood was rated hazardous. The FHA denied the developer financing due to its close proximity to the hazardous Black neighborhood. And as a compromise, the FHA agreed to finance it, provide the guarantees, provided the developer build a foot-thick, 6-foot wall for a half mile to separate the Black and white neighborhoods. And you can see that wall in the distance in this picture. And I think that really just speaks to the incredible levels that the industry was willing to go to to preserve segregation in this financing system. So what's the impact of the FHA? Well, the data is not entirely clear, but an analysis reveals a clear pattern of redlining in center city areas with abundant loan activity in the suburban counties. Between 1946 1960, for example, 350,000 homes in Northern California were financed with FHA. Less than 100 were for African Americans. A 20-year study of Philadelphia concluded that FHA policies virtually guaranteed that few homeowners in these areas, and by the areas it meant older homes with African Americans, were the beneficiary of FHA insurance. So overall, during this time period from 1930 to 1960, which was one of the greatest expansions of home ownership in American history, scholars have demonstrated that fewer than 1% of all mortgages in the nation were issued to African Americans. And again, then where does that take us? It takes us back to installment contracts. So without access to the traditional mortgage market, African Americans were targeted by real estate speculators for installment contracts to purchase homes. And if you go back and you look at the African American newspapers in any major city, you'll see they're filled with property advertisements, and they typically list low down payments, but no total sales price, which was a clear indicator the property was being sold on contract. At the same time, a secondary market begins to develop for installment contract paper. And this in turn provided liquidity to the market and allowed for the speculators to continue to flip properties, issue installment contracts, sell those contracts, and generate more capital. And in fact, speculators and investors often recoup their entire equity investment within just 2 years. So extremely lucrative and profitable for the speculators. And again, this was the primary tool if you wanted to purchase a home. In Chicago, an expert estimated 85% of the properties sold to African Americans in neighborhoods undergoing racial change were financed with installment contracts. Another 1962 study in Chicago found the same thing. The study also found not only were they being financed with installment contracts, but African Americans on average paid a price that was 73% greater than the original price paid by the investor. So again, it's the exact same dilemma as sharecropping, as the first wave installment contracts were buying properties at inflated prices on predatory and discriminatory terms. I want to give you an example of this and how this works, because I think it's really somewhat remarkable. So the Jameses, so they purchased a home on contract from Charles Peters, who was a real estate speculator, for $13,500. Now, Peters told the Jameses that the home was occupied or owned by a white couple, but in reality, he had purchased the home just 13 days earlier for $8,000. So he bought it and marked up the price. The contract required a down payment of $1,000 and monthly payments of $105, with a balance of $10,500 due at the end of the term. So basically, a balloon payment was attached to the contract. Now, Peters promised to help the Jameses secure that mortgage to finance the balance at the end of the term, given that they might have troubles because, quote unquote, because they were colored. However, after 1 year, Peters sold the contract at a discount to Arthur Kruth, who was a liquor store owner. But nearing the end of the contract, the Jameses, who did not know about that, sought out Peters in the hopes that he would fulfill the promise of assistance. He told them, since he no longer had an ownership interest in the property, he could care less what happened to them. The Peters then attempted to secure mortgage financing. Their application was denied by 6 banks since the property was not worth $10,500. Remember, Peters had only paid $8,000 for it in the first place. Truth proceeded with eviction. The court rejected the James's efforts to delay the eviction in the hope that they might secure financing, and ultimately they were evicted from the property. So I think this example really speaks to the way that these installment contracts worked in a very sort of vicious, predatory manner with predatory terms and conditions and exorbitant sales prices. But the issues with financing were not just into home ownership. At the same time, large national retail stores are typically operating in suburban areas and avoiding African-American neighborhoods. So in the absence of these traditional realtors, African-Americans relied upon small merchants operating stores in segregated neighborhoods to purchase consumer products, such as appliances and furniture. So again, what do we have here? We have the merchants, again, in the African-American neighborhoods, 100 so years later than sharecropping, but sort of the same dynamic. So the realtors courted customers through advertising, promises of easy credit, door-to-door sales. Most of the purchases are financed. In fact, the FTC found 92% of the sales in such stores were credit sales, compared to 27 at general retail stores. So again, similar dynamic where all the sales are being financed. And most consumer lending took the form of installment loans. Typically, they had high interest rates, and retailers often charged more than the legal limit by simply elevating the base price of the goods. So again, inflated prices, high interest rates. And Paul Dixon, who was chairman of the FTC at the time, explained sort of how the pricing worked. So selling at wholesale was about $100. It would retail for $165 at a general store, but for $250 at a local store. You know, a huge price premium. And however, these consumers were basically in a captive market, given there was little to no price competition among the realtors or retailers, and borrowers often fell into continuous debt relationships with these merchants who operated in African-American neighborhoods using a wide range of exploitive practices, ranging from high-pressure sales tactics, misleading bait and switch, misrepresentation of prices, shoddy merchandise, substitution of used goods for promised new ones, refusing to repair or replace, and quite frankly, outright fraud. And contract defaults often entailed repossession, wage garnishment, court judgments, and even outright shakedowns that could even include violence by merchants. So by 1967, the Fed does a study about the racial wealth gap. And it concludes that the evidence appears overwhelming that the net wealth position of Black families is substantially poorer than that of white families with similar characteristics. Then looked at sort of African Americans and whites at higher income levels and those at lower income levels, and found large disparities. For instance, for those higher earning African Americans, they had a net wealth of $30,000 compared to $100,000 for whites. And at the lower end, it was almost $11,000 versus $2,000. So the Fed study concluded that the source of the wealth gap was historical inequalities in income and opportunities, a legacy of past economic deprivation, and it could not be fixed by only eliminating the income gap. So the Fed itself is, I think, noting the long history that we have already covered today. So I think that then takes us to what I'll call the third generation of credit discrimination, reverse redlining, which some of you might be a little bit more familiar with since it happened not too long ago. So beginning in the late 1900s, early 2000s, subprime lending increases dramatically in the United States. And the subprime product, basically, it's intended to provide credit to individuals who do not qualify for prime loans. And while it can serve a beneficial purpose by providing access to credit for someone who might not ordinarily qualify, It also was subject to widespread abuse. It typically had high interest rates and fees. It often involved flipping or repeated refinancing designed to strip equity out of a product or out of a home. High pressure sales, advertising tactics, prepayment penalties, balloon payments, and again, outright fraud. Unfortunately, African-American areas were frequently targeted for subprime products and often predatory mortgage loans in a practice known as reverse redlining. So how does reverse redlining work? So residential segregation combined with lack of access to credit from the mainstream financial institutions essentially created market conditions favorable to targeting Black areas for subprime and predatory loans. So essentially you have a market failure that results in a credit vacuum in Black neighborhoods, allowing lenders to aggressively market and exploit such areas with predatory loan products. So you see this combination of unfair products, the targeting of African Americans, which is sort of the exact opposite of redlining, hence the term reverse redlining. Again, very prevalent in the African American neighborhoods. So HUD study found 51% of refinance loans in African American areas were subprime compared to 9% for white areas. Income was irrelevant. African American families earning more than $200,000, so quite well off, were more likely to get a subprime loan than a white family making just $30,000 a year. And even after you control for underwriting variables, or you consider other factors, African American borrowers were up to 34% more likely than whites to receive a high rate subprime loan during this time period. So of course, then we have the subprime mortgage crisis when basically everything collapses. So the targeting of minorities for these products had major consequences when the market collapsed in 2008, including increased debt, loss of equity, increased foreclosure, and entire devaluation of neighborhoods. Overall, for example, just between 2005 and 2008, 240,000 African Americans lost their homes to foreclosure, and you really see that in the wealth decline. Just in that short 4-year time period, the net worth of Black households declines by 53%. They all basically cut in half over a 4-year time period, while white households declined by just 16%. So, where does that sort of take us today as we're in this post-subprime mortgage crisis? Well, African-American homeownership reached a 52-year low in 2019 at 40.6%. It was down 9% from its high in 2004, where it almost hit 50%. And it continues to be quite high today, as I mentioned in the beginning of the presentation. So, we see all sorts of contributing factors: tightening of credit standards, continuing redlining. I think it's fair to say we've seen a reemergence of contract lending in some areas, and continued discrimination. And I think we also have to consider, we could be on the potential verge of a fourth generation of potential credit discrimination with COVID and the impact that it's having on minorities in minority communities. We definitely see disproportionate infection rates, unemployment rates, small business closures, evictions and foreclosures. It's still pretty early, and certainly the federal government has responded through sort of foreclosure moratoriums in various programs. But I think we need to be very cognizant of the impact, the racial impact that COVID-19 is having on minorities and minority communities as we're currently living in this right now. So what to do? So what is the impact of all this? So overall, one study indicated that if the disparities in home ownership rates were eliminated, in other words, you equalize those rates, that 30% gap becomes nothing. The wealth gap between Black and white households would shrink 31%. And then if you combine that with equalization of equity, because African-American homes typically appreciate often at slower rates. But if you equalized appreciation, that would shrink the wealth gap by another 16%. So the combination of those two, home ownership and equalized results in appreciation, would almost wipe out half the racial wealth gap, according to one study. So overall, in conclusion, I think one of the primary explanations for the large racial wealth gap is the historical and structural discrimination in the credit markets. As the last slide indicated, it's as many as potentially 50% of that gap, with the remainder, by the way, being income and to a smaller extent, education. Now, these structural and historical discriminatory patterns, which we've now sort of covered from the Civil War, just after the Civil War, all the way up to now, has limited African-American wealth accumulation, I think, at least two significant ways. It's limited African-American home ownership due to lack of access to traditional sources of mortgage credit, which we've seen, through the practices of redlining or the subprime lending crisis. And it's also increased the cost of achieving home ownership due to increased reliance on non-traditional sources of credit. And by that, I mean installment contracts, basically. So I think what I've tried to argue and show through history is this two-part problem where there's a lack of access to fair and equitable credit, and the alternative is typically high-priced, potentially predatory and discriminatory. And those two factors, and I think in large rate, have driven the home ownership gap and in turn, the racial wealth gap. So with that, that concludes my presentation. Let's see, we've got a couple of minutes left.
Thank you, Charles. That was excellent. And we do have a bunch of questions also in the chat. So I'm just putting this slide up and we'll leave it here so everyone can, the third sort of paragraph down is where the email is if you want to get a copy of the slides or have other questions. I'm going to answer as many questions as I can. Those that I don't get to, if you send in, if you request the slides, I'll go ahead and send an answer to any questions we don't get to. Hopefully we'll get to most of them. So let's see here, Charles, I don't know if you're looking at them now, but let's see. We'll start with the first one that came in around 2:30. And that question was from David Rowe. A lot of them are from Mr. Rowe, and I'll cover as many as we can. We may skip just a few just to get the others, but I don't think there were a lot of others besides that. He asks, is the housing gap because of not being able to get a home loan or not being able to keep the home? But I think you did a good job of explaining that in the last few slides. So I think he may, that was earlier. So we probably can skip that one. Were Blacks allowed to own land? Maybe you can answer that one. Of course, early on they weren't. I think you talked about, I don't know around what time. It looked like around the late 1900s there that Blacks began owning land. Is that correct? No, it was earlier than that.
Yeah, certainly in the North, Africa, or during sort of the slavery period, free Blacks could own land in some areas of the North, and in fact did own land. Obviously not in the South. And then immediately after Emancipation, African Americans were not legally prohibited from owning land due to some of the civil rights amendments that were passed, as well as some of the civil rights laws that were passed. So legally, no, but as I think what we saw with the example of Mr. Crawford, it was potentially quite dangerous and onerous to achieve land ownership. And quite challenging. So I think the answer to that is after the Civil War, it was not legally prohibited, but certainly all sorts of other issues associated with those efforts as we discussed in the presentation.
Thank you. We had somebody post, Benita Johnson posted a link to Slavery by Another Name, and that was in reference to you talking about the peonage system. So that link you might want to visit. That was around 2:23 for those that are trying to find it.
Yeah, definitely. And I don't mean to suggest that sharecropping was sort of the only sort of labor system out there, that work really talks about the convict leasing system, where folks were often wrongly convicted of crimes and then leased to major companies, essentially to perform labor in what were just brutal conditions. And that's an excellent historic read if anyone has the time.
Okay, and I also see a question from Mr. Rowe about whether white sharecroppers were offered different interest rates, and I think you also covered that later, and that in fact they were, and that I think you said around 1925 the black interest rate was in the 20 to 24, and the white was 4 to 5% around that time.
I mean, it's definitely true that more whites became ensnared in this system, although they faced and probably were charged high interest rates. I'm not sure they rivaled that of African Americans, but the violence, the lynchings, the additional obstacles that I think were unique to the African American system, or unique to African Americans in the sharecropping system, were not necessarily applicable to whites. So, you know, it is definitely historically accurate that whites became increasingly ensnared in sharecropping. But I think it's also fair to say that the system, while oppressive, it was different in some respects from the African American experience.
Okay, and we had a message from somebody, Corey Carmichael, that said he wanted to know about using the slides and the recording for them to brief others, and absolutely, that's all of our materials. We welcome you to do that. And Dr. Nair has graciously allowed us to use his slides, which come from his personal research, for the same purpose. And he mentioned that he was glued to the screen, so thank you for that. And so that Dr. Nair,
everything's available. And, you know, if you have any interest in a subsequent follow-up presentation, or have others who are interested in hearing this, feel free to reach out and we'll see what we can arrange. Great,
thank you. And David also asked about the mortgage rate in 1925. That I looked up, and it was 4 to 5%. We have something from Reverend Dr. Suzanne Kershaw, and she asked, is this the Citizens Bank we know today? I think she was speaking on slide 48. You mentioned Citizens Bank.
It is not. It is not. Ultimately, the Wrights sold their controlling interest, and it became a white-owned bank. It ultimately collapsed, I believe, in the late 70s, early 80s, but it is a different institution.
Okay. Let's see. Somebody asked about the impacts of Black Wall Street decimating riots in Tulsa and other cities across the country.
I mean, I think that's, you know, consistent with, you know, the experience that Mr. Crawford had. We talked about in sort of the dynamic of violence that was used as a tool of oppression, and was central in some respects to white supremacy in the United States, where wealth accumulation by African Americans was a potential threat to the economic system that prevailed. And be it Mr. Crawford owning land in South Carolina, or the success of African Americans in Tulsa, it's essentially the same dynamic that generated sort of the violent response to those successes.
Okay, it's 3:31. I'll just squeeze in two other quick questions real quick, and then I think we'll have to wrap up. But one says, were institutions willing to make loans to whites to buy in Black communities? Do you have any information on that?
Yeah, that's a good question. I have not come across a lot of data on that. I suspect no, because of the notion of race in real estate value. And the importance of segregation. So if a white person was trying to buy in an African American neighborhood, that would still challenge sort of the segregation boundaries. So I haven't seen any information on that, but I would suspect sort of the same dynamic would be at play. Now later on, that's going to become an issue, I think, more recently when we begin to talk about issues associated with gentrification and things like that. But back then, I'm not aware of much historical research on that particular aspect of it. It's a good question, though.
Yeah. I'll give one more question, and those after that, if you send an email reminding me of your question, we'll try to get it answered directly to you. The last question, I see a lot of REI, I think it's real estate investment groups that promote rent-to-own contracts to get low-income, poor credit consumers into properties. Is this the new form of installment contracts by predatory REIs targeting poor credit consumers who don't have down payments? Does the CFPB have any program that warns consumers about these rent-to-own gimmicks?
Good question on whether we have any programs. It's certainly true that we're aware and have taken notice of the IREI issues. I know other federal regulators have certainly are aware of those and cognizant of it. I do think in some ways it is quite similar to sort of the installment contract issue, if not almost identical. And it is definitely something that presents, I think, some significant discriminatory and fair lending implications.
Okay, there's a lot of other good questions in here. So I hope some of you will repeat your question in an email to me. Again, my email is that I get these responses in is the third sort of link from the top of this, CFPB _FinEx@cfpb.gov. And we'll try to get those back to you. Well, again, thank you so much, Dr. Nair, for your time. This has really been great. Lots of positive comments on your presentation. And I'm sure you'll get other calls and invites to this because it really is fantastic information. Thank you, everyone, for joining. And please do check out some of our links, because educating your consumers about their rights regarding credit, and we have a lot of information on that on our webpage, and also letting them know where to go if they have a problem through our consumer complaint and response line. These are two important ways that you can use what we have to help your consumers that you serve, Black and Brown and others and everybody, overcome any challenges they face and being treated fairly in the markets. So everyone have a great day, and I'll look forward to maybe seeing you on Thursday from 2 to 3. We have a webinar on CFPB resources for service members and veterans. Take care.